What we covered last week is we talked about independence, and we talked about professional skepticism. What this case does is bring together those two concepts in a real type of case environment, or world environment, I should say, in terms of the responsibilities that auditors have on their engagements and how they work with their clients in coming up with the right solution or the best solution for the financial reporting process. So we also talked about independence, but we talked about it mostly from the perspective of the rules, right? When we talked about Rules 101, we had all those bright line rules. We saw the video where the audit partner talked about the fact that they can't have financial interest in their client. They're excluded from performing certain services for their clients. So these are what we call bright line rules. You can easily look at the auditor and determine whether or not they violated any of these rules. We term that what type of independence? Does anyone remember? That's considered independence. Independence in fact, appearance. Why do you say appearance and why do you say fact? You first. If you had your name pen, I'd be able to say your name and not call you you. I'm going to try this. I'm going to change my name every single week, and you have to figure out what it is. Let's reverse roles here. Okay, well, why don't you tell me appearance first before you... Okay, go. Right, I understand, right? So that's kind of overarching, right? But with respect to Rule 101, you said that was independence and appearance. So why is it independence and appearance versus independence and fact? What's the difference between those two things? Why don't you tell me, Ralph, why you think it's independence and fact?
Well, independence and fact, it's like a more objective thing, like
it's the opposite. Independence, because it's independence in fact is something internal to the auditor, right? I can't tell if you were independent in fact. After the fact, I can have hindsight, but hindsight is 20/20, right? It's not real time. It's after things have happened, I make an assessment about whether or not I considered you to be independent, whether your actions were consistent with what I expect an independent auditor to be. So independence is fact, is something that the auditor knows. Did you make the right decision, or did you base your decision on unbiased, in an unbiased manner? Did you allow incentives to influence your decision? Only the auditor knows that, right? I, as an observable third party observing that, I don't know that. Independence and appearance is something I can see because I can point to the rules. There's verifiable evidence, right? I can find out if the auditor had an investment in a client, right? I can find out if the auditor has a wife has a relationship or husband has a direct financial interest in the client that the audit partner is auditing. So those are things that the independence and appearance is these bright line rules. Independence in fact or mind is something that the auditor knows, and that is not as observable to a third party, okay? So today what this case is going to talk more about or get to is the kinds of things that contribute to this independence in fact and independence in mind, right? That things that people might look at and start to think differently about independence or question or challenge the auditor's independence. So remember when we looked at the independence video, one of the examples that followed was this banker was considering whether or not they should loan money to the client that was audited based on the audited financial statements once they found out that the audit partner's wife had a significant business relationship with the client. And most of the responses that you guys offered was that you would have some pause about that. You would be concerned, you probably wouldn't loan them money, or if you did loan them money, you would charge a higher interest rate, or you would put some conditions on the loan. So in other words, you would protect your investment by trying to reduce your risk, or at least be compensated for the risk you were taking because you did not believe the auditor, or you couldn't be certain that the auditor was 100% objective and unbiased. So we're going to talk about that. So before we move to the case, I just want to go through some of the definitions and expectations with respect to auditors, what their responsibilities are, and how the various regulatory bodies view the auditor's responsibility with respect to independence. So the auditor's responsibility is to issue, for publicly held companies, so for the clients that hire them, their responsibility is to issue an opinion on the client's financial statements. Remember, it's the client's financial statements. They prepare it. So the reason that auditors are doing this is because there's this capital market, a third party, that place some emphasis on that. That signals something to them when they see this auditor report. So investors and other users expect the auditors to bring to the financial reporting process integrity, independence, objectivity, technical competence, and to prevent the issuance of misleading statements. So remember, in the auditor's opinion, the financial report, what they're saying is the statements are free of material misstatements, that they're materially correct. That's what people are looking for, that line that says there are no material misstatements in the financial statements, right? So if you look at this, and this is just taken from comments made by the Comptroller General at the time of the U.S. And so think about all of these things: integrity, independence, objectivity, technical competence. Where do we see those words? What did we cover last week where we saw those terms? I'm sorry? Professional skepticism, right, but what's the, definitely as when we talk about professional skepticism, we refer to that terminology, but where's that terminology coming from? What guides auditors, or CPAs, I should say? GAS guides them, PCLB guides them, and we have a code of professional conduct, right? The code of professional conduct. The AICPA, right, which also issues a statement on auditing standards, also is responsible for the professional code of conduct, says in all matters relating to assignment and independence and mental attitude is to be maintained by the auditor. The independent public accountant must be without bias with respect to the client. If not, they lack impartiality necessary for people to be able to depend on their findings. Whether the accountant is independent is something that he must decide as a matter of professional judgment. Okay. And the AICPA code also points to two components of independence: independence of mind and independence in appearance. The code can guide independence in appearance. The auditor has to guide independence in mind. The SEC, responsible for the financial markets, right? Commission will not recognize an accountant as independent with respect to the audit client if the accountant is not or a reasonable investor with knowledge. So if the accountant is not, or the people using those statements don't believe that he or she is, would conclude that the accountant is not capable of exercising objective and impartial judgment. Back to the example after the video. The banker did not believe that the auditor was capable of exercising objective and impartial judgment. Right? So it gave them concern about whether or not they would loan money to their client. The Independent Standards Board. The Independent Standards Board has been disbanded. I think it was 1997, in the mid to late 90s. The Independent Standards Board was established as a kind of a joint not project, but a joint agreement between the AICPA and the SEC, because there were concerns about auditor independence, and that whether or not auditors were always acting in the most independent way possible. That they were concerned about the perception of the markets and users of financial statements with respect to the independence of auditors. So the Independent Standards Board was established, and I think it was disbanded either somewhere early 2000. Like, I think it was 2001 or 2002. I can't remember exactly. But their charter was to look at the threats to what is independence, what it should be, how independence is being carried out in the profession, the perception of independence amongst users of the financial statements, what caused auditors to not be independent. Some of the things that came out of that would be things like non-audit services, providing non-audit services to audit clients. So they define auditor independence as independence of mind, which is freedom from the effect of threats to auditor independence, would be sufficient to compromise an auditor's objectivity. So there are things out there, right, that's not bright line rules that can impair an auditor's independence. And basically saying that, you know, the auditor has to be aware of these types of things that could give investors and users concern about the integrity of the findings, the integrity of the audit report. So what kinds of things potentially impair auditors' independence, or aside from things like auditor incentives generated or resulting from the auditor providing services to the client that are not related to audit, right? So they're fees. So they're generating fees from non-audit services. So those are types of things. Because the auditing firms are a business. They're trying to make money. They employ thousands, hundreds of thousands of people, and they're trying to make money. Other things would be former audit firm personnel being employed by the client. So we know through SOX that these two things have been addressed because SOX says you can no longer provide non-audit services to your audit clients. They prohibit certain non-audit services, a lot of them. It also says there has to be this one-year cooling off period before an auditor can join the client in a significant financial oversight role. So those things are pretty clear. However, there's still things that give regulators concern about auditor independence, or where auditors' independence might be impaired. So the resolution of difficult, complex accounting issues, right? And the reason for that is because they're judgment-based. And what they're finding is when auditors are presented with these types of issues, that's where their professional skepticism is not as robust as it should be. So, to no surprise, the case that we're going to do today, right? The case involves a subjective accounting issue. What makes it subjective? It's an estimate, right? So management has a position, auditors have a position. Somehow they have to agree on what the right amount is that should be reflected in the financial statements so that the financial statements are not materially misstated. So what are accounting estimates? Obsolescence, warranty reserves, allowance for doubtful accounts. Those are all estimates, right? If you remember your financial accounting, and I know Danielle knows this, she told you this, right? How do we come up with the allowance for doubtful accounts? How's that determined? Okay, it's an estimate. What makes it an estimate? Right, it's based on previous history, right? Age and schedule that is prepared by who? No, if the accountant prepared it, they would no longer be independent. The client prepares it, right? The client prepares it, the auditor is going to audit it, right? So what academic research has shown, and what's borne out in the inspection being done by the PCAOB is that the auditors are failing to really understand a lot of times management's process for these estimates. So you might, clearly when you are in your financial accounting class, it's straightforward, or, you know, how you come up with the aging, because it's given to you. This is the aging number, and what's the journal entry you book. It's not that simple from an audit perspective, because the auditor doesn't just audit, but take the numbers that the client gives them, check the list, you know, recalculate everything and says it's all fine and well. They have to understand management's thought process and rationale for coming up with those buckets. It's not enough that it's in a bucket. Well, why that bucket? Why that percentage should you apply to the bucket versus another percentage? So what they're finding is that auditors don't always understand that process, and because they don't always understand the underlying assumptions that management's making, they can't effectively audit it. Also, a lot of times because of time pressure, because we have checklists, auditors might be going through this robo kind of auditing process. They're just trying to finish, okay? And as a result of that, they're not being skeptical enough. They're not asking the right questions. They're not, because they're so honed in on just completing the task, they're not understanding the underlying process that goes to the task, goes into developing the numbers. As I pointed out, this is showing up in the PCAOB inspection reports. What they're finding is that most of the deficiencies that they're finding are related to accounting estimates. They're related to these complex judgments. Because the reality is, things like cutoffs are black and white. Did you sell the goods? Yes. Did you ship them before year end or after year end? So cutoff is really easy. Shipment, in most situations, shipping of the goods or providing the service, right, dictates when you record it in your financial statement, when you record revenue, right? When you incur a cost, right, determines when you recognize that expense in your financial statement. Those are pretty black and white. But imagine if it's not that black and white, where you have to determine, did I actually, did I fulfill the service? There are a number of revenue type transactions that are not as simple as shipping or perform, or, being able to point to the date that you perform the service. Right? So those things require a lot of judgment, and that's where the PCAOB is seeing that there are a lot of complex judgments in auditing, and auditors are not doing really well at identifying those judgments or making the right judgments. So again, it's due to a lack of professional skepticism, and they're not really critically thinking about some of these underlying processes. And so as a result of that, they're not effectively auditing. We're going to talk next week about management assertions, and what management assertions are, I'll go into more detail, as I said, next week, is management makes statements about the financial statements, right? Because the auditor has to be able to rely, at least as a starting point, on management's financials, the information that management's giving them, and then they audit that information. So management makes statements about the financial statement. So they're going to make a statement that all sales transactions that we've engaged in for the calendar year are reflected in the financial statement. Right? That's an assertion that management makes, that auditors then go out and they audit that. They try to determine whether or not that is indeed the case. There are a number of, depending on what the accounting estimate is going to dictate the appropriate audit procedures. But because accounting estimates are by nature, they're estimates and they're judgmental, there's not always this nice, clean trail of information or evidence to support those estimates. A lot of times it means, similar to the obsolescence reserve or the allowance for doubtful accounts, that the auditor has to really get in and understand how management's coming up with that, what the rationale is, and determine the best approach to audit that. And so it could vary from client to client. So they're definitely difficult to resolve. And because it's judgment, your judgment could be very different from my judgment. Let's just think if we had a used car. Somebody was selling a used car. I'm interested in buying it. I'm going to make you an offer based on what I believe that car is worth, but you're selling it based on what you believe it's worth. Who's to say? Why is my number better than your number, right? It's judgment. And so we get into this process of negotiating. So you don't want to think about that from an audit perspective, that auditors are negotiating, and auditors will tell you that they don't negotiate. But the fact of the matter is, whether you call it negotiation or discussion or an interaction, the fact of the matter is, my position is over here, your position is over there, and some way we have to find a position that works. That's going to satisfy me and satisfy the client. That's negotiation. So some of the things that result from that, or potentially result from that, is auditor, in hindsight, people can look at that, third parties can say, well, their independence has been impaired because the number should have been, 100,000, but the auditor only allowed the client to record half that amount. And here's some of the reasons why we think they did that. Okay, they've been on the client too long. They didn't staff the client with the auditing team with the appropriate level of competence of auditors. So again, can you say that the auditor actually impaired their independence? From independence and appearance perspective, they're fine. But you don't know if they're independent in mind or independent in fact. Professional skepticism is key there for obvious reasons. You have to critically assess that information. The client is going to have incentives to want to report a number that they have. You have to challenge that as an auditor. And obviously, the failure to do that will impact audit quality in a negative way. So how do auditors and clients resolve their differences over accounting estimates? You're going to tell me how they do that, because you're going to break into teams and you're going to resolve the two issues in the case. So the case involves two issues: the inventory valuation issue, obsolescence, and accounts receivable valuation alternative related to the allowance for doubtful accounts. Both of these have balance sheet and income statement implications, so there's financial statement implications. So what I want you to do in your team, auditor team one and client team one, are going to resolve these issues together from each of their perspectives, and all of the other teams as well. You're going to pair with your client team. I want you to obviously come up with an agreed upon inventory valuation, an agreed upon accounts receivable, allowance valuation. Note take into account what the financial statement implications are going to be for each of the alternatives. Be able to justify why your alternative is the better alternative, or why you believe it's the right alternative, I should say. And also, auditor teams and client teams, you're going to need to think about how you are going to get the other team to agree to what you want them to do, okay, or to agree to the number, or to accept your position.